Hello. Today we are going to discuss about IFRS 11, and that is joint arrangements. My name is Paul Palawe. I'm a certified chartered accountant, a member of the Association of Chartered Certified Accountants, SCCA. And displayed below are my contact details if you are willing to engage me in any of the lessons. I'm available. I'll take you through any accounting subject except financial management. Okay, any accounting subject. Okay, let's dive straight into our discussion. Joint arrangements is quite an exciting topic, very easy. We are going to have a good experience. You just have to follow our introduction. The big question that we are going to answer today is, what is a joint arrangement? And what are the types of joint arrangements? Okay, when you talk about joint arrangement, what is it that we refer to? So basically, joint arrangement is defined as an arrangement where two or more parties to an arrangement have a joint control. Significance is joint control. If two or three people come together with a purpose of doing business and they agree that they're going to have a joint control, that is contractually agreed, or they agree to share the control. That, my friends, is joint arrangement. So the joint arrangement may take the form of either the joint operation or the joint venture. Okay, so the key distinction between the two forms of the joint arrangement is based upon the parties' rights and obligation under the joint arrangement, the contractual agreement between the parties. That's the distinction factor or the distinguishing factor between the two. So basically, an examiner would want to test you mostly, especially SBR students. The examiner would be willing to find out from you whether you know the distinguishing factor. They'll give you a nice case. Okay, in that case, they throw in one or two or three things for you to identify whether the arrangement is a joint operation or whether the arrangement is a joint venture. So there's a two-step analysis that must be followed to classify a joint arrangement. And that is, one, you must assess whether the collective control of an arrangement exists. So the question is, what is a collective control? When you talk about a collective control of an arrangement, we are looking at when all parties, where all parties must act together to direct the activities that significantly affect the returns of the arrangement. Okay, collective control. Number two, you must assess whether the contractual arrangement gives two or more parties a joint control. The arrangement that has been agreed, the contract that has been agreed between the parties, does the contractual arrangement gives two or more parties a joint control? Okay, so a joint control is a contractually agreed sharing of control of an arrangement, which must exist only when the decisions about the relevant activities require the unanimous consent of all the parties sharing the control. For a decision to take place, all the parties must take control, okay? Or must have a say, must have a voting power. An example to be given where two parties to an arrangement have agreed that for an investment to be made of a certain level, a decision between the two must be made, or a voting power is shared equally. You understand? So that's the significance. So let's look at what a joint operation entails. So when you talk about a joint operation, these operations are defined as a joint arrangement whereby the parties have the joint control. Okay. And in this joint control, the parties have the rights to assets and obligations of the liabilities, according to IFRS 10 Appendix A. Okay. Normally, when we talk about the joint operations, they will not be a separate entity. They will not establish a separate entity to run the operation. They just agree. Okay, let's start selling, let's say, fish. Okay, one company is doing their own business, another company is also doing their own business. They agreed to run a joint operation. Okay, they win a project somewhere and they start running operation together. Okay, but a separate entity won't be established for that operation to take place. That's a significant part. Okay, an example: A and B decide to enter into a joint operation to produce a new product. So A might undertake one manufacturing process and B undertakes another process, or might run operations for that new product to be on the market. So A and B have agreed that decisions regarding the joint operation will be made unanimously, and that each will bear their own expenses and take an agreed share of the sales revenue from the operation. Elon Musk might agree with Jeff Bezos to go to the moon. Okay, for them to go to the moon, they need a vehicle, they need a shuttle. So these people, they're all billionaires. Okay, they are all technically competent. They've got the equipment, they've got the manufacturing capital. They might agree, okay, let's create a vehicle where we can go to the moon or to Mars. Okay. And Jeff Bezos, sorry for using that word, because I know they're in the business of transporting people to and fro. Okay. And one company might agree to invest in part A and part B. The other company might agree to invest in part C and D, up until they bring forward a vehicle that takes people to the moon. That's basically an example. But no separate entity will be established for them to carry on with the operation. So all this depends on the jurisdiction in which this is happening. Some jurisdiction won't allow two companies to come together to invest without creating a special entity, a special company. Okay. So the accounting treatment for joint operations is when, if the joint operation meets the definition of a business, then the principles in IFRS 3 combination, business combination, apply when an interest in the joint operation is acquired. Okay, we looked at IFRS 3 business combination in our previous discussion. So if you haven't gone through that video, please go through and make yourself aware of what IFRS entails, business combination. So number one, acquisition costs are expense to profit and loss incurred. Number two, the identifiable assets and liabilities of the joint operation are measured at fair value. And number three, the excess of the consideration transferred over the fair value of the net assets acquired is recognized in goodwill, joint operation. Okay. So to continue, at the reporting date, the individual statements of each joint operator will recognize, number one, its share of assets held in the joint operation. Number two, its share of liabilities incurred jointly Number 3, its share of revenue from the joint operation. And number 4, its share of expenses from the joint operation. And largely, the joint operator's share of income and expenses, assets and liabilities of the joint operation are included in its individual financial statement. And so they will automatically flow through the consolidated financial statements. In a nutshell, if you're working together as a joint operation, there is no any special entity that exists for you to report. So you report, you add the expenses and revenue in your own books of account separately. These companies add expenses and revenue and assets and liabilities in their own books of accounts separately, according to their share of what they have spent. Okay, because obviously the expenditure would come in their own name as a legal entity, and liabilities would also be in their legal entity's name. So it makes sense to do that. So what is a joint venture? For us to have a distinguishing factor, let's look at what a joint venture is all about. So joint ventures are defined as joint arrangements whereby the parties have a joint control of the arrangement, number 1. Number 2, and they have the rights and the net assets. They have the rights to the net assets of the arrangement, according to IFRS 11. Okay, what any other distinguishing factor? So joint ventures will normally be established in the form of a separate entity to conduct joint venture activities. This special entity can be regarded as a legal name, a persona. Okay, we'll look at examples. So the legal form of the separate vehicle is considered in initial assessment of the parties' rights to the assets and obligations for the liabilities held in the separate vehicle. Then when the joint arrangement is structured through a separate vehicle, the legal form causes the separate vehicle to be considered in its own right, meaning that the assets, number 1, and 2, the liabilities held in the separate vehicle are the assets and the liabilities of the separate vehicle and not those of the parties. Since these people, these companies have created a legal name, okay? The assets that exist in the legal name is not an asset and liability that belongs to the legal entity, separate legal entities. You understand that? That's a distinguishing factor. So an example, if A and B decide to set up a separate entity called C to enter into a joint venture, then A will own 50%. For example, if A owns 50% of the equity capital of C, with B owning only 45%, A and B have may agree that decision-making regarding the joint venture will be unanimous. And no person, no company can make a decision on their own unless otherwise stated in the contract. But the decision here is being made unanimous, meaning to say neither party will have the direct right to the assets or the direct obligation for the liabilities of the joint venture. Instead, they will have an interest in the net assets of C set up for the joint venture. In other words, they will have a share in the residue, okay, the net assets. So if the company is operating as a joint arrangement, as a separate legal entity, as a separate legal company, let's have an example for us to understand thoroughly what joint ventures entails. Rain Limited and Snow Limited contractually agreed to have a joint control over Ice Limited, a newly formed company. Rain Limited and Snow Limited each hold 50% of equity shares of Ice Limited. and Rain Limited and Snow Limited collectively have a 50-50% voting right and have the control over ICE Limited, and they will have to act together to direct the activities that significantly affect the returns of the arrangement. Rain Limited and Snow Limited have joint control over ICE Limited, as they have contractually agreed to share control over the company. Now, decisions about relevant activities require the unanimous consent of Rain Limited and Snow Limited. ICE Limited is a separate juristic person incorporated in terms of Companies Act, that's South African Companies Act 71 of 2008. ICE Limited is the legal owner of its assets and responsible for settling its own liabilities. So ICE Limited was formed to produce a specific type of raw material used by Rain Limited and Snow Limited in their own production processes. ICE Limited sells the raw material to Rain Limited and Snow Limited and other external parties. So the major significant part of this example, we should break it down to make sure that we understand fully what the examiner is looking for. So the big question is, identify whether the company is a joint venture or a joint operation. What are the things that we should look for in this example? So here we are saying that the consideration for classifying this joint arrangement is as follows. Number one, the structure. Let's look at the structure of the company. The joint arrangement is structured through a separate vehicle, namely ICE Limited. And it could be classified either as a joint operation or as a joint venture at this stage. Okay. However, the legal form of a separate entity, that is to say, ICE Limited is a company and a legal persona in its own right, thus separate legal person. Meaning to say, the assets and liabilities of ICE Limited are its own and not the assets and liabilities of the separate companies, namely Rain or Snow Limited. So Rain Limited and Snow Limited only have the equity interest or the residue in the business. Okay. Number three, the terms of contractual arrangement do not modify the rights and obligations as determined by the legal form of ICE Limited. So there are other factors that we need to consider for us to reach a conclusion that the arrangement that was set is a joint operation or a joint venture. So the other facts and circumstances do not give Rain Limited or Snow Limited rights to the assets and obligations for the liability of ICE Limited. So ICE Limited also sells the raw materials to other external parties, apart from selling the raw materials to the two parties in agreement. Okay. So in this case, we can conclude that the joint arrangement should be classified as a joint venture. Okay, that is what the examiner is looking for. So given this question in exam, number one, assess the facts in the given case. Don't be excited to just jump into conclusion before assessing the facts, because the examiner will be waiting for you to break down the case with the facts, okay, as we've put it here. What is the structure of the arrangement? Does the arrangement gives a guarantee of a legal form of a separate entity between the parties to the arrangement? Okay. What are other factors that have been given in the case that gives you confidence that the arrangement is operation or joint venture? Okay. So as a consultant in an SBR, as you are taken as a consultant, you need to give facts, not insinuate. Okay. You should not insinuate or give an assumption without a basis. The examiner will be looking for you to present any facts. After presenting facts, speak out your mind according to the facts that you've presented. Okay. So the accounting treatment for the joint venture, how is a joint venture accounted for? So in the individual financial statements, an investment in joint venture can be accounted for at cost. Number two, it can also be accounted for in accordance with IFRS 9, that is financial instruments, or by using the equity method, whatever method fits the case. You understand? So there's no fixed way of accounting it, depending on the case that you're given. All right. So in the consolidated financial statements, the interest in the joint venture entity will be accounted for using the equity method. The treatment of the joint venture in the consolidated financial statement is therefore identical to the treatment of an associate. You remember the equity method, opening balance, any share of the profits that occurred in the accounting period, and you have the closing balance. Then you disclose. Okay. So in summary, the diagram given simplifies or answers the questions. And if you ask yourself questions, and you should be able to reach a conclusion whether the arrangement is a mere joint operation or the arrangement is a joint venture. So what are we saying here? Joint arrangements. Repeating what we said, the joint arrangement is an arrangement over which two or more parties have a joint control. The main issue here is control. So for you to assess and classify the joint control, ask yourself, are parties collectively controlling the arrangement through a contractual obligation? Are the parties to the arrangement have a collective control? If the answer is no, obvious that one is not a joint arrangement. You must apply other standards applicable to that specific arrangement. That one is not a joint arrangement. Okay? If your answer is yes, then ask yourself, are decisions about the relevant activities require unanimous consent between the parties to an arrangement? If your answer is no, that one is not a joint arrangement. But if your answer is yes, ask yourself, is the arrangement jointly controlled? Okay, the arrangement, is it jointly controlled between the parties? That is to say, if it is jointly controlled, that is a joint arrangement, obvious. Okay, so classification, rights, and obligation of the parties to an arrangement. That is to say, if your answer is yes on the question of is arrangement jointly controlled, then ask yourself, what is the structure of the arrangement? Okay? If the arrangement is not structured through a separate vehicle, that, my friends, is just a joint operation. Significance, or the significant factor to determine between joint arrangement and joint venture, is a structure. So does the structure or is arrangement structured through a separate vehicle? If your answer is yes, then what do you need to do? You must consider the legal form, number one, two terms, and the contractual arrangement and the other facts and circumstances within the contract between the parties. Okay? It can either be a joint operation or a joint venture, depending on the facts in the case. Okay? So just to summarize, what are we saying? A joint operation is an arrangement where the parties that have a joint control of the arrangement have the rights to the assets and the obligations for the liabilities relating to the arrangement. Whilst in a joint venture, the parties have a joint control, number one, of the arrangement and have the rights to only net assets. What are net assets? That's for you as an accountant to answer. Total assets minus current liabilities. That's possibly that, depending on where you are. Okay? My friends, you must not miss this. This is your determining point. Okay? The determining point between joint arrangement and joint venture. So under joint ventures, we're concluding to say joint ventures recognize the investment and account for it using the equity method in terms of IAS 28, investments in associates and joint ventures. Whereas the joint arrangement in joint operation, we are saying joint operators recognize their own items in the financial statements and their share of items shared jointly in terms of IFRS 11. So in the joint venture, that's when a separate legal entity is established and the name can be Paul Mpalawe and let's say Robert Chingapa and associates, okay? Where these two gentlemen have agreed that we are going to run this business using a separate legal entity. Okay. So another example, Blast has 30% share in the joint operation. Okay, for this one, what I did was to copy the same question in Excel so that we analyze the facts, because this one needs a bit of time. We should analyze the facts bit after bit for you to understand fully what the examiner is looking for. So I urge you to keep attention, be attentive in this one, because it's exciting. It's exciting, very exciting. So Blast Limited has 30% share in joint operations. The assets and liabilities, revenue, and cost of the joint operation are apportioned on the basis of shareholding capacity. Shareholding capacity. The following information relates to the joint arrangement activity for the year ended 30 November 2022. The manufacturing facility cost 30 million to construct. So number one, manufacturing. Manufacturing facility, that is PPE, okay? Cost 30 million. Here it's gonna be in the dollars, yeah, dollars, million, precision, okay? Let's account for it bit after bit. Well, first of all, let's go to the question. Show how Blast will account for the joint operation within its financial statements for the year ended 30 November 2022. So basically, I'm gonna produce the extracts, but I like breaking the question given step by step. So to construct and was completed on 1st December 20X1. This one was completed on 1st December 2021. Okay. The present value for the dismantling costs to the joint arrangement as at that date, using a discount factor of 8%, was 3 million. So the present value, PV, present value of this dismantling cost, present value of dismantling cost, 3 million. Cost of cabro, 8%. Okay, we'll see how we can apply that. And during the year, 30 November 2022, the joint operation entered into the following transaction. Goods with production cost 36 million were sold for 50 million. So sales 50 million. Cost of sales for those goods, that is 36 million. Okay. Other operating costs incurred amount to 1 million. Other operating costs 1 million. And administration expenses incurred amounting to 2 million. Admin cost amount to 2 million. Excuse administration, okay. Blast has only accounted for its share of the cost of the manufacturing facility, amounting to 9 million. Okay. This one is what? Administration facility. The mini facility, that's PPE, 9 million. Okay. The revenue and costs are receivable. Revenue and costs are receivable. It means all this are receivable and payable. All this the company hasn't paid or received. So there's an aspect of receivable, okay, and payables by the joint operation parties who settle amounts outstanding with Blast after each reporting date. So the question is, show how Blast will account for this. Remember, in a joint operation, you need to account for cost, revenue, and assets and liabilities with your share. The share here is 30%. Okay. The share for Blast share is 30%. So how can this be accounted for? So since we are doing the extracts, we are preparing the extracts, we're gonna say we have information with us here. What are we going to say? It's clear to say that in P&L, profit and loss account extract, we are going to show the following. The rate of share is 30%. Okay. So it's as simple as taking sales 50 times 30%. Or we can do this, put it here, and look all. Okay. I mean to say we can easily drag. We can easily drag the formula. So revenue, 50%, the share for the company is 15. That is to say 30% of 50. Cost of sales, 36. The share is 10.8. And other operating costs is 1. The share is 0.3 million. Admin cost is 2. The share is 0.6. What any other cost should we consider If we look here, we are given a note to say dismantling costs to the joint arrangement as at that date using a discount factor of 8% were 3 million. Out of that 3 million, we can say finance cost. Finance cost, that is 3 million. We're gonna say 30% of 3 million times 8%, which is 0.08. Okay, that is 0.72. That is our finance cost. We can also calculate depreciation because we are given a note to say the asset was erected in, where is that? The manufacturing facility cost 30 million to construct and was completed on 1st December 2021. It means if we take 30 million, okay, we divide it by the useful life, which is how many years? So the total cost, remember, when you are accounting for cost of manufacturing or cost of erecting a building, we also consider dismantling cost as part of the cost. That is to say 30 million plus 3 million. Then we need to find the share, that is times 30%. Okay, times 30% share, time, okay, divide by 10. That 10 shall represent 10 years. Or we can say 33 million divided by 10 years times 1 for 1 year times 30% for the element of the share. So what are you gonna say? It's gonna say 30, open bracket, 30 plus 3. You need to think fast with these things. Divide by 10 years times 1 year for 20x2 times a share of operation, that is 30%. That is 0.99. What any other activity do we need to calculate? So that basically is the share of the operation. Share of the operation. Let me see if there's anything that has come to my attention. Okay. 1 million, 0.3, that is correct. Okay. All right. So there's another aspect that we need to account for. That is statement extract. Statement of financial position. Okay. What are the things that we should take here? In terms of property, plant, and equipment, we are given already that the company, the Blast here, Blast has only accounted for its share of cost of manufacturing facility amounting to 9 million. So 9 million, this one is straightforward. Okay, we are not to take any share on that one. What else do we need to account for? Trade and other receivables and assets, trade and other receivables. Remember, we are told in the question that the revenue and costs are receivable, and payables. Okay, the revenue and costs are receivable and payables by the two other joint operation partners who will settle the amounts. It means the 15 that we found here, all right, the 15 that I found here, sorry, the 15 that is here is receivable. It hasn't been received yet. It's going to be received within 12 months. Okay. What else do we need to account? Under non-current liabilities, the issue with dismantling cost, dismantling cost, we're given in the question that dismantling cost is going to be 3 million. Okay. Out of that 3 million, we need to take a share of 30%. From that result, we also need to add a finance element. Okay. The financing element of 0.072, because it's going to happen in the future. Unwinding interest, in other words. So we are saying, open bracket, 3 million times 0.3, that is a share, plus 0.072, that is 0.972. My friends, that one is non-current liabilities. What any other extract should we account for? Current liabilities. Okay. Under current liabilities, remember all payments, payables haven't been paid. Payables, all expenses in the P&L haven't been paid. That is to say, cost of sales, which is 10.8, plus other operating cost 0.3 million, plus admin cost 0.6 here, admin cost 0.6, and finance cost, is finance cost part of that? Has the finance cost been paid? I think finance cost is straightforward, because that one is taken, is paid by the bank, straightforward. So the share of that is part of current liability. So 10.8 plus 0.3 plus 0.6. That is 11.7. Why haven't we taken depreciation as part of payables? Someone would be asking, why didn't you take depreciation? Remember, depreciation is notional cost. It's an assumed cost. It's not like you're going to go in the bank and pay for depreciation. You understand that? And we also didn't include the financing cost, because finance cost is an element of, it's an issue to do with it's cash. Okay, it's taken out completely by the bank. Okay, and in this case, finance cost is a notional cost, because we are discounting the future dismantling cost. It's not even related. This one is not related to the bank. This one is a notional cost. It's a future. It's a future. It's a cost that is accounted on the future cost of dismantling. That is why we didn't include admin, financing cost and depreciation cost. Okay. So, and assets. Under assets, I've just remembered one thing. We need to include trade receivable. Okay, trade receivables we included already. Yeah, I think that's all. We should be good. We should be good. So the examiner will basically mark you based on line item. Half a mark, sometimes 1 mark, and so on and so forth. So what points should we remember? Or we can go to the answer to check if we are in line with what the examiner is looking for. Okay, let's do this. Stop. Share. Let's scrutinize the question again and check if we are okay. We should be fine. We should be fine. We should be fine. From current line. Okay. So let's check the solution. Okay. There is our 50 million with a share of 30%, 15, 10.8, and so on and so forth. Statement of financial position 9 given, dismantling cost as calculated, the total 8.9, receivables 15, and dismantling cost 0.79 as given. The current liabilities, okay, they didn't take, as we stated, finance cost and depreciation. If you can see clearly here, they didn't account for those with the reason that I gave you. So the amounts calculated above should be classified under the appropriate heading. Every line in appropriate heading. Don't make a mistake. Okay. Note also that where the amounts owed to and from joint operation partners may be accepted. It may be accepted to show just a net amount due to or from other partners in the joint operation. Okay. As calculated. So last but not least, the disclosures. IFRS 12 disclosures. I should say that the disclosures for the interest in other entities, it's prescribed in IFRS 12, where the entity have to disclose the interest in a subsidiary, joint arrangement, or an associate. So the disclosure requirements of the joint arrangements are addressed in IFRS 12,7. And an entity must disclose information to enable users of the financial statements to evaluate the nature, extent, and financial effects of the interest in the joint arrangement, including but not limited to the nature and the effects of the contractual relationships with other investors with the joint control, as well as the nature and the changes in the risks associated with those investments in the joint arrangement. And also that an entity must disclose information about significant adjustments and assumptions made in determining, number one, whether the entity has a joint control of the arrangement or significant influence over another entity. Number two, the type of the joint arrangement that is there. It may be a joint operation or a joint venture. If the arrangement was structured through a separate vehicle or not. So the following information must be disclosed separately for each joint arrangement, which includes joint operation and or joint ventures that is material to the reporting entity. Number one, the name of the joint arrangement. Number two, the nature of the entity's relationship with the joint arrangement. Number three, the principal place of the business where the joint entity is operating, a country of operation, if applicable. Okay. Number 4, the proportion of ownership interest or participating share, and if different, the proportion of the voting rights held in the company. So, ladies and gentlemen, that's the end of our discussion today. If you may be willing to refer back to where I took the information from, you are free to do so. You can consult SCCA SCBR Strategic Business Reporting. I used Kaplan 2023, and you can also use Descriptive Accounting, International Financial Reporting Standard Focus, the 21st edition. All right. I wish you all the best as you are going through this lesson again, and as you are following me through the next lessons that are to come, and all the best. Thank you.